Hello, and welcome to episode 3 of our Stop Destroying Your Trading Account podcast. Today, two of us will be hosting this podcast. My name is Carl.
And Daniel.
Both of us are with Halifax, America, a Los Angeles-based brokerage for futures, stocks, options, and Forex. As you probably know, this presentation is about everything that you can do to blow up your trading account, plus solutions you can implement to avoid these errors.
We are going to teach you how not to blow up your trading account and how to avoid common errors that too many traders seem to make over and over and over again.
So let's get started.
In this episode, we are going to talk about stop losses. Stop losses are supposed to help you reduce your losses by cutting them short. And for that reason, many traders think that by simply placing stop losses in their trades, they are practicing good money management.
But contrary to what you might think, stop losses, when used recklessly, can actually accelerate your losses. Yes, you can lose lots of money by practicing money management the wrong way.
Although there are plenty of ways to screw up your account by poorly planning or executing stop losses, here are two of the most common ways traders get this wrong.
Number 1, not knowing the difference between a money-based stop and a market stop. This is an error that is particularly common among day traders who have small trading accounts. The flawed logic goes like this. I won't lose more than X amount of dollars per trade. Let's say it's a small amount, such as $50 to $200. The mistake here is obvious, but it tends to happen consistently. Here's how it works.
What if the market support exceeds the loss amount? Say a trader has a bracket order for a $50 stop loss, but market support on the chart would require a $75 stop loss. In this scenario, you might get stopped out only to see the market go in your direction after it had bounced off support, or if you are short, bounce back from resistance.
So in other words, if you're trading technicals where support and resistance are critical factors, it might make sense to use a market-based stop loss rather than a money-based stop loss. Again, this varies depending on the strategy in the market, but for most traders who make this error, it's pretty simple. Many traders lose money by using a money stop against a market-based stop.
Now, moving on to number 2, placing stop losses that are too close to the entry price. Many tight stop losses may reduce your risk per trade and increase your frequency of trades, but in the end, you may end up getting stopped out much too often, taking smaller losses on a per trade basis but larger losses on a cumulative basis. Now, in this case, you need to make sure that your reward to risk ratio is significantly stacked to the former. But this is very difficult to do, and although many traders attempt it, very few achieve it in the long run.
That's correct. And note that there are several other errors people make with stop loss placement, but these two are perhaps the most common ones. Now, they may seem obvious that you might think that they're not worthy of a podcast episode, but despite the commonsensical nature of the matter, there's a reason why we are dedicating an episode to call out these errors. It's because it happens way too often.
So now, there you have it. Stay informed, stay prepared, and stay competitive.
Signing off, this is Carl
And Daniel.
with the Halifax, America team.